Hi, Brock VandenBerg, Fund Manager for TaliMar Income Fund and President of TaliMar Financial. Today, I want to respond to a common question that I get from investors, and that is the typical duration of a loan in the portfolio and how we balance high loan turnover with the need for liquidity. When adding loans to a mortgage fund, one of the most important and often overlooked considerations is loan duration. Loan duration directly impacts liquidity, risk, and overall portfolio performance. And understanding how it works provides meaningful insight into how a fund is managed. At a high level, loan duration refers to how long capital is deployed into a specific loan before it is repaid. In a real estate-backed lending strategy, this is typically driven by the borrower's business plan, whether they're renovating a property, stabilizing an asset, or executing a short-term bridge strategy. As investors, it's important to recognize that duration is not just a timing factor. It plays a key role in balancing liquidity and consistency of returns. Shorter duration loans, for example, provide increased liquidity to the fund. When loans are repaid more quickly, that capital is returned and becomes available to be redeployed into new opportunities. This flexibility allows the fund to adjust more quickly to changing market conditions, whether that means taking advantage of higher interest rates, tightening underwriting standards, or shifting focus across asset types. From a risk management standpoint, shorter durations also limit long-term exposure to any single asset or borrower. However, that benefit comes with a trade-off. When adding shorter duration loans to a mortgage fund, there is a constant need to replace those loans as they pay off. This creates what is often referred to as reinvestment risk. If capital is returned faster than it can be redeployed into new, high-quality loans, it can lead to periods where cash is sitting idle, which may dilute overall returns. It also requires a consistent and reliable pipeline of new lending opportunities to maintain performance. On the other hand of the spectrum, adding longer duration loans can reduce the need for frequent reinvestment. Capital remains deployed for a longer period of time, which can provide more stability in the portfolio and reduce the operational demands tied to loan turnover. However, longer durations also reduce liquidity and can increase exposure to changing market conditions. If interest rates rise or market dynamics shift, capital may be tied up in loans that were originated under a different set of assumptions. This is why duration management is so important when constructing and maintaining a mortgage fund portfolio. It's not about choosing short-term or long-term loans exclusively. It's about finding the right balance. In our view, an ideal loan duration typically falls in the range of 12 to 18 months. This timeframe allows borrowers enough runway to execute their business plan while still maintaining a level of turnover that provides the fund with flexibility and ongoing access to new opportunities. A 12 to 18-month duration strikes a balance between liquidity and stability. It allows the fund to recycle capital at a measured pace without creating excessive pressure to constantly originate new loans. At the same time, it limits long-term exposure and enables the fund to adapt to evolving market conditions over time. From a portfolio management perspective, maintaining this balance requires discipline. It involves carefully underwriting each loan, understanding the borrower's timeline, and managing the pipeline to ensure that as loans pay off, they can be replaced with equally strong opportunities. It also means being selective, prioritizing quality over volume to ensure that capital is consistently deployed into well-structured asset-backed investments. For investors, understanding how loan duration is considered when adding loans to a mortgage fund provides a clearer picture of how the portfolio is managed. It highlights how liquidity is maintained, how risk is controlled, and how returns are sustained over time. Ultimately, loan duration is a key lever in delivering consistent performance. By targeting a balanced duration profile, the fund is positioned to remain flexible, responsive, and disciplined across different market environments while continuing to focus on its core objective, preserving capital and generating stable, risk-adjusted returns. Thank you for taking a moment to watch this video. Hopefully it answered some of your questions regarding loan duration in our loan portfolio. If you liked what you watched, please consider giving it a thumbs up and subscribing to our YouTube channel where we post a lot of content about investing in mortgage funds. If you're interested in learning more about TaliMar Income Fund, feel free to reach out to me or my investor relations team. We'd be more than happy to talk to you about an investment in the fund. Thanks again for watching.